Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder at Delphi Digital, where we're 5 full-time analysts focused on institutional crypto research. If you aren't a subscriber, you're missing out, so visit the site while you're listening. One quick housekeeping item. This podcast is strictly informational and educational and is not investment advice or solicitation to buy or sell any tokens or securities or to make any financial decisions. I may personally own tokens that are mentioned on the podcast, and you can view the show notes for our full disclosures. Hey everyone, today I had the pleasure of recording with Jeff Dorman, who's the CIO at Arca, which is a crypto-focused hedge fund. This is a great episode because Jeff has a storied career in finance, starting with investment banking at Lehman, then capital markets, and trading at Lehman and Merril before going to the buy side. So Jeff brings a ton of great insight from a finance and a Wall Street perspective to crypto. So with that, let's jump in. Hey everyone, welcome back to the podcast. Today I'm thrilled to have on Jeff Dorman, the Chief Investment Officer at Arca. How's it going, Jeff?
I'm doing great. How about yourself? Thanks for having me.
Good. It's going great. So Jeff, give us your quick background and how you got started in crypto.
Sure. The word quick, we'll try to focus on that. I started my career in traditional finance a little under 20 years ago. I was an investment banker at Lehman Brothers. I then moved over into the capital markets desk, basically actively syndicating debt and equity deals. Then I moved over to a trading desk and I traded high yield and distressed for Lehman and Merrill Lynch. That was through the financial crisis. After the financial crisis, I went to the buy side. I worked for Citadel as well as a couple smaller hedge funds managing equity and debt portfolios, across basically every asset class, every region, every sector. And then in 2013, I took a break from investing and I helped start a fintech company called Harvest Exchange, which is basically Facebook for asset managers, a place for asset managers to put their content out there, their blogs, their white papers, basically reach an investor audience. And it was at that time that I started working with developers every day. We had 12 full stack developers on the Harvest team. They were very into open source code, obviously. I started to learn about how important that was, using GitHub every single day. And also a lot of them were mining for Litecoin and Bitcoin. So I learned about that and I started personally investing in 2016 and then ultimately moved out to Los Angeles after 17 years in New York and met my partners and we started Arca.
That's awesome. Great background. And you come from traditional finance, which is great, but new to a lot of people in the space. It's run by all tech people, as a lot of us know. So give us Arca's focus. What's the day-to-day like at Arca? What's the focus of the fund, or are there multiple funds for people that are new to it?
Sure. Arca is a full-service investment management firm focused on digital assets. And we basically create and manage institutional products. So what that means is we have two sides of our business. We have an asset management arm where we are actively investing in both the digital assets themselves as well as into the companies that are supporting the infrastructure of this space. And on the other side of our business is our product creation arm, and we are actively creating blockchain wrapped products. So the analogy there would be just like the ETF didn't create a new asset class, it was just a vehicle to help you invest better in equities and debt and currencies. We feel blockchain will be the wrapper of the future, and we are doing the same thing on that side of our business, creating regulated products that people will be able to buy via blockchain.
It's awesome. You guys are in the weeds. So for people new to finance and funds and investing here, would you say that your fund is more focused on liquid tokens versus equity investments and venture capital investments or early protocol investments? Or do you think that you guys are basically cover the whole landscape here?
Yeah, we have a couple of different fund structures. One of the things I learned early on in my career is that you never really want to have just one strategy because that can go in or out of favor at any given time. And also investor needs change. And you ultimately are creating products that are sellable and scalable as much as they are profitable. And you need to have something that meets the risk reward mandate of your investors. So we have a couple different strategies. Our flagship strategy is a digital asset strategy, which is a long-only event-driven strategy, where we are actively investing in tokens, a combination of long-term deep dive research, as well as catalyst-driven investing, and a little bit of a trading strategy overlay as well. And then in other vehicles that we have that are either launched or pre-launch, we're doing some of the other things like investing in the equities of blockchain businesses.
That's awesome. And there's been a lot of hype recently around venture funds. Pantera just closed or is closing a $175 million fund. Pomp's on our board. He has a venture style fund. Why do you think that venture funds are able to raise insane amounts of money, but like regular token long only funds or hybrid structures maybe have a more difficult time raising capital?
Sure. Taking a step back to even how you get there, right? The all of the funds you're speaking of are just forms of alternative funds. And even 20 years ago, almost nobody invested in any alternative funds, right? They were your basic index funds or your mutual funds and very simple strategy products. Then hedge funds started coming out in the 80s and 90s, which offered a different type of fund. It started with some long short funds, and you had merger arb funds. Obviously, there's all kinds of different subcategories now of alternative funds. So in the history of investing, even just the word alternative fund is fairly new. But like anything, investors have to get used to this new structure, and they have to figure out where it fits in an overall risk bucket. So venture funds or private equity funds fit into a sleeve of that alternative basket. And that is something that investors are very comfortable with. Even if you are solely investing in the equity of blockchain companies like a Coinbase or a Kraken or a digital assets data or something like that, you're still just investing in the equity of a private business. And that's something that investors are very comfortable with, and they've been doing it now for decades. So that's an easier lift for an investment committee, whether that's a pension or an endowment or a family office, than say investing in a digital asset fund where the underlying is something that they've never invested in before. Don't underestimate how, from an operational standpoint, what that means, right? They have to learn about new custodians. They have to learn about new fund administrators, how to mark their positions, how to figure out what your clients actually, or what the funds actually own. So it's just a different lift, and it's not insurmountable. It just takes longer. And, we're in an industry right now where everybody tries to do everything immediately. And the reality is some things just take time, like due diligence.
Yeah, that's a really good point. So basically what you're saying is that since the venture funds are already exist in traditional finance, pension funds, large endowments can already allocate to them regardless of it being a new space.
Yeah, exactly. I mean, they already have a sleeve in their, investment mandate that allows for venture investing. And what you're actually investing in is not necessarily as relevant as the structure of what you're investing in. So for them, the structure is the same, whereas investing in a hedge fund that's investing in digital assets, while the hedge fund structure is similar to what they're used to, it's very different when the underlying is a token.
Yeah, that's a good point. What do you think will push traditional endowments, investors, pensions to be able to be okay with investing in the tokens and the liquid portion of the market versus the VC angle?
Yeah, I mean, the short answer is just time, right? Time is what it'll take for these investors to start to understand this. But the path to get through that time is starting with education. There's a lot of firms, including ourselves, who put out a lot of content or a lot of blogs and educational materials. Obviously, for those of you who are familiar with my partner, David Nage, he has a podcast like yours. The podcast you're doing, we do blogs. There's all kinds of things out there that help these investors get up to speed faster. So that's where it starts. Then it is trying to, as there's more data sets, that helps these investors to understand where this fits in the efficient frontier of investing, or even just with their own specific mandate. These guys are very good at asset allocation, and they're very good at figuring out risk return profiles, but there has to be data sets and longer time horizons for them to figure that out. So, that's a couple of big things that goes into this. And then the third one, I think, which is probably the most important, is just a lack of investable products. These investors are massive. They physically can't invest in this space if they try. I mean, some of the pensions and endowments we're talking to have 30, 40, 50, 100 billion in assets, right? Even a 1% allocation from something of that size is bigger than any of the funds that exist. So, the market has to, it's sort of a chicken and egg a little bit, right? A lot of people say when the institutional investors come, that's when the market grows. The reality is the market has to grow first for the institutional investors to be able to even invest.
Yeah, those are great points on the path to adoption. And keying in more on the technical or the infrastructure hurdles for investors in the space, do you think when you sit down with people, is it more infrastructure like, hey, the custodians don't exist yet, or the trading platforms don't exist yet? Do you think it's more regulation holding them back? Or do you think it really comes back to what you're saying on education, and the pieces are really there already for large investors to be in the space outside of the allocation problems you talked about?
Sure. Yeah, it's a good question. And it's changing. I mean, a year ago, it was all about the infrastructure, right? Is there a custodian? Is there a fund administrator? Am I going to get hacked? What are the security risks? The reality is a lot of that has now been solved for, right? I mean, obviously some of the crypto native companies like a Coinbase or a Zappo have solved some of that, but also players like Fidelity getting into space. Same thing on the exchange side, right? It's not just the Coinbase and the Binances, but now you have TD Ameritrade getting involved. You have eToro over in Europe. You've got big companies that are getting in this space. So a lot of the issues that were last year, I think, have been solved for. Now, I think it's much more about just trying to figure out again where this fits in the portfolio. So one of the analogies I like to use a lot is, investor pushback is always going to be on what is Bitcoin or what is a digital asset or how do you value it? And everybody feels like they have to be an expert on that in order to invest. But when you pull down the curtain a little bit or you pull back the curtain and you push them on that, one of the analogies I use is I say, have you ever invested in a healthcare fund? And usually an investor will say, yeah, sure. And I say, okay, well, tell me exactly how Medicare reimbursement works or how phase 3 drug trials work or how the patent process works or how hospital admission rates work. And of course, they don't know because they're not paid to know that and they shouldn't know that. What they do is they do a due diligence process to find a healthcare manager who does understand that stuff. And then they realize that healthcare has a place in their portfolio and they figure out how to put it together. And that's where I think digital assets are going to come in. They're not going to know everything about exactly how the Bitcoin halving works or how hash rate works. They're not going to understand exactly, how a Binance coin works and how the burn rate works. They're just going to understand that digital assets are a real asset class. There are real tokens that have and accrue real value. And they're going to go out there and do their manager due diligence the same way they've always done and find people to shepherd them into the space.
Yeah, that's a really good point. I feel like it's hard today because there's just so many facets of crypto, from game theory to governance to the tech to the investing, the tokens. I feel like everyone tries to be an expert on every different level. And basically your point is that once we're able to abstract that away so people could focus on one layer, they'd be more easy to invest over the long term.
Yeah, that's what I believe.
Gotcha. And turning back to your time at Citadel and Lehman, when you are investing in the space or talking to investors, what's the whole due diligence process like now versus then? I feel like today we spoke before the podcast, people just get money and they start investing from day one.
Yeah. Well, it's funny, right? Because in a lot of the unwritten rules of hedge funds are be secret and don't give away your secret sauce and just, never tell anyone what you do. And that worked really well in 1985 when there was 10 hedge funds, right? And it was like an exclusive club where you were lucky to even get an allocation to a hedge fund. Now there's 10,000 hedge funds, right? There's thousands of venture firms and thousands of private equity firms. And it's like, the reality is it's shifted where you now have to be much more transparent to even get on someone's radar. It's the equivalent of, if you were applying to a job 30 years ago and there's only 3 applicants, it didn't really matter what was on your resume. Well, now the resume is a major screening point just to filter out the applicants and get down to a reasonable level. So the same thing's happening in the alternative fund space. The actual due diligence process probably hasn't changed that much in terms of the rigor and the time and the efforts that it takes to learn about who's going to be managing your money. But the process of screening and filtering and just absorbing the constant information flow, the investor letters, the fact sheets, the updates and the webinars and all that kind of stuff is a lot to handle. So teams are just getting a little bit bigger and more sophisticated at that sort of screening and evaluation process.
Great points. And, I spoke to a close friend, Tim McDonald, earlier a couple weeks ago. And one of the things he pointed out, it's obvious to us because we're in crypto, but he said, large investors don't want to be in this 24/7, 7 days a week market. They want somebody to handle all that risk. They want someone to be up all hours of the night to handle that. Are you seeing that as an edge for leading a fund for investors versus those investors just allocating to Bitcoin and kind of forgetting?
Well, I think, in general, again, it goes back to what your skill sets are, right? So a lot of the institutional allocators out there, right? The pensions, the endowments, the family offices, they're not set up to trade actively anyway. They're set up to evaluate risk and to have models and asset allocation. So I don't think it matters necessarily how often it trades. It's just not really their skill set. That being said, certainly if their choice was, do I want to just buy Bitcoin, hold it and forget it, or do I want to invest in a actively managed fund? Yeah, I think the fact that they're going to be woken up at 3 a.m. oftentimes with an alert or having to trade is something that's not super appealing. And certainly knowing that there's a team that's monitoring and evaluating and reassessing 24/7 would certainly be what I would call a sleep at night factor, right? No. Something that allows them to be in this space without feeling like they have to dedicate their lives to it.
It's a great point. And Jeff, let's turn for a second to your new post. You publish a weekly post. It's called That's Our Two Satoshis. Awesome name.
Shout out to Sasha Fleischman, who came up with it, one of our young traders on the Arca team.
Yeah. Great guy. And it's ar.ca/blog if anybody wants to check it out. You have a new post out. It's on debunking the laziest argument against crypto, and it focuses on intrinsic value. What led you to write this post?
A lot of what we do in this space is really, people ask, what's the competition really? The real competition right now is the status quo, right? People are very set on narratives and valuation techniques and things that they've always done. Now, of course, all of them have to start somewhere, right? If you were an investor in 1920 before the Graham and Dodd book came out, you didn't have any of the tools about valuing equities or bonds as you do today. But most of us we're not alive then, so we don't remember that in 1920. But the reality is, if you look back at the equity market, people used to buy equities based on the price, independent of the number of shares and the market cap, which seems silly to us today, but 100 years ago didn't seem that silly. They just didn't quite understand it. So as we're going through this process of educating crypto to new investors, a lot of them are just stuck in their ways, some of which are, for good reason, some of which don't make that much sense. And one of the arguments I hear over and over again that I just have really struggled with is Bitcoin has no intrinsic value or crypto has no intrinsic value. And I think a lot of people in the space have done a pretty good job of arguing why that's not true, that Bitcoin and crypto does have intrinsic value. But what I've learned over the years is it's very hard to change someone's mind when they are dead set on something. It's easier to then attack something else that they do understand. So instead of trying to say that Bitcoin had intrinsic value, I'm going the other way and challenging that nothing really has intrinsic value. So if you look at what does intrinsic value mean, right? Intrinsic value means what is the value of it on its own? And the argument against Bitcoin or crypto is that there is no value on its own. It's only worth something because other people think it's worth something. But that same thing could be said for a lot of different things, right? Like if you were buying Facebook equity 15 years ago, there was no intrinsic value. Intrinsic value for a stock literally means what are the assets less the liabilities. And 90% of the stock market, both public and private, their assets don't cover their liabilities. There is no actual shareholder value. The shareholder value is created through valuation techniques like present value, DCF, things that value future cash flows. Well, to value a future cash flow, you have to be speculative. You have to assume that there's going to be new sales, there's going to be new cash flow, there's going to be new buyers who are willing to pay a multiple of that, right? The PE ratio of the S&P 500 was 14 or 15 last year. Now it's 19. Nothing's fundamentally changed except people in the equity market believe that somebody else would pay 5 times more per earnings than they were a year ago. That is not a growth of intrinsic value. That is a growth of speculative value. So same thing with the bond market. I used to be in the high yield bond market for a long time. And for those who aren't familiar with high yield, these are junky, risky companies, right? Ones that don't have a lot of cash flow and don't have a lot of asset coverage. Well, what's the intrinsic value of a bond? The intrinsic value of a bond is literally the recovery value if there was a default, right? What are you actually getting back in your principal if the company no longer can service its debt and its cash flows? Well, almost every high yield company has very little cash in the balance sheet and very little cash flows to cover all their debt. So the recovery value on these bonds is, sometimes 0 or 10 or 20, but they're trading at 100 with, high interest rates. So the intrinsic value itself doesn't really mean anything when the actual trading values in the market are at many, 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 many multiples above what this intrinsic value is. And that's, I think, the argument that if we can start putting that into the narrative more, questioning what people believe they actually own, rather than trying to change their mind on what we're doing, I think it might help put crypto in a better light.
Yeah, that's really interesting framing. And it's the first time I've heard this argument. Do you think that people are okay with the intrinsic value argument for stocks because we have such long-term set in stone valuation models where in crypto we don't? And do you think that if we're able to build out real valuation models, we can solve that problem? Or do you think that this is a new industry and we may never have the same valuation techniques?
I think both. I think, like anything, data sets are important and time is important. So again, when you have 100 years of history of a PE ratio or price to sales or enterprise value to EBITDA, eventually that narrative becomes so strong that people forget that at one point that didn't exist. So yes, with crypto, with things like NVT or MVRV or a lot of the work that your great team at Delphi does, I mean, there's certainly new techniques and valuation tools out there that eventually become mainstream, right? I don't know when that Malcolm Gladwell tipping point occurs, but at some point that tipping point occurs and this stuff becomes mainstream, just like a lot of what we view in the equity and debt market. But on the flip side, the digital asset space is a lot more than just Bitcoin, as insiders know and a lot of outsiders don't know. Even some of the people that are attacking crypto probably have no idea that there's an entire ecosystem below just Bitcoin and Ethereum. So when you break down the actual digital assets that exist in this market, they're very unique. And again, I'll go back to a parallel to the bond market. A lot of bonds are very unique as well. You have different maturities, you have different coupons. Some of them are callable, some of them are puttable. You've got converts, you've got amortizers, you've got some bonds with warrants. Like, there's not a single valuation technique that works across all of these bonds. There's many different ones that work to value the different subcomponents. And the same thing is true when you're looking at an exchange token like Binance Coin or Bitfinex's Elio that has a massive buyback and burn model, or something like a consumer product that has a token with a low inflation rate or something that has a high inflation rate. I mean, there's all these different nuances that are just much different than a straight valuation technique like you see in the equity market.
It's a great point. And let's think in the future. Let's say that we're able to develop some real valuation techniques that are able to price in, the real values, hypothetically, or the real values of cryptos. Do you think that we'll lose our edge as investors if we're able to accurately value these things? I feel like a lot of the value today comes from the fact that we really don't have set valuation techniques today. So things have the ability to become massively overvalued pretty quickly.
Well, yeah, I'd say a lot of the volatility and a lot of the fun for retail investors and keeps you up at night for institutional investors comes from that lack of valuation, the lack of agreeing upon where this stuff should trade. But the reality is, even if you have very set valuation techniques and very long data sets, people will still disagree on value and price, right? That's what makes markets, right? Is a disagreement on either the current price or the future values of where these companies are going. So even if everybody 100% agreed that this is where Ethereum should trade today based on this one model that everybody uses, well, people are going to have different viewpoints on where Ethereum is headed 3 months from now, 6 months from now, 12 months from now. And that disagreement is what's going to cause two-sided markets and ultimately creates price action and ultimately pays managers like myself for doing the research and making those tough decisions.
Absolutely. So going back to modeling, you guys released a report on the Elio token. That's a business model that's based on a real business and has very clear token economics that you can build models around and back into, quasi valuation or what you think the burn will be, et cetera. There's some real numbers you can work with there. Bitcoin, Ethereum, others, it's very hard to back into like a model without just doing a relative comparison or something like that. Do you think it's easier for you to go to potential investors and kind of pitch Elio as part of your portfolio versus Bitcoin? Like, I'm wondering if it's easier to pitch the future of a digital store value like Bitcoin, or is it easier to pitch something that you could really build a model around?
Yeah, that's a great question. Actually, I don't think anyone's ever actually asked me that. So, but it's a good point. I think just like we talked about the venture capital funds and why these VC funds are getting more investments than a digital asset fund is because investors understand that more. And to your point, yes, it is much easier for an investor to understand a cash flow producing company that has a real equity base and is ultimately using a portion of their cash flows to burn tokens. And effectively, you can run that through a DCF analysis or an NPV analysis. So I think that is certainly something that is easier to understand. That being said, something like Bitcoin is literally in the narrative every single day at this point, and they've all heard of it. So I think there is a growing number of institutional investors who are starting to understand that as well. I think where the disconnect comes from is that the word cryptocurrency is so damaging because everybody now assumes that everything in the digital asset world is a currency. And as a result, there can't be 2,000 currencies. So if you focus just on Bitcoin, you say, okay, I either believe that this is going to be a currency or I believe this is going to be a store of value or a medium of exchange or not, right? And if you can get past that, then at least you might have an opinion on whether to buy Bitcoin. But if you go even further than that and you say, okay, well, what are these other things that are out there, these other coins, these other tokens? Again, they're so unique and so different that you have to start somewhere. And we prefer to start with the cash flow producing tokens because one, they're easier to model. Two, these are real businesses that have real money that can support upturns and downturns in the market. And three, we think that they're incredibly undervalued. But yeah, as you look at how investors are just used to seeing things, there's certainly value in presenting something to them that is similar to what they've seen before, rather than taking something that is, they don't even understand the definitions, let alone the valuation techniques.
That's a great point. And Jeff, you're a professional money manager here, so it's a community-based question, but how often when you're looking at cryptos or digital assets beyond Bitcoin, do you care about the tech and the community and what's going on and their mainnet release? Or is it more focused on, we're here to make money, let's find a good entry, and let's hopefully make some money on this asset?
Sure. I mean, the tech is super important. I mean, none of us would be in this if we didn't believe in the long-term tech and, the various nuances of that technology. The difference, of course, is different fund strategies have different mandates. If you're a 7-year venture capital locked up fund and you don't have to worry about mark to market or daily volatility, and all you're doing is trying to find good entry points and ultimately have an exit 7 years later, that's a much different strategy than a digital asset fund that is marking to market every single day and having to show how you manage your position sizes according to different risk, how you handle different events and catalysts. So the tech is ultimately incredibly important. The communities are ultimately incredibly important, but doesn't necessarily drive prices every day or every week or every month. So, at Arca, for instance, we have different buckets of risk. Our long-term research bucket is a 12 to 36 month time horizon. The tech is all that matters in that. I mean, obviously, price matters a little bit in terms of the sizing of a position, but ultimately you're either believing in the tech or not over a longer time horizon. We have an event-driven, catalyst-driven bucket, which is much more news-driven and much more specific around events and easy to define catalysts. Tech is largely irrelevant in something like that because you're really focused more on day-to-day events. So it's just different strategies, different buckets for different types of funds.
That makes a lot of sense. And do you think that we'll always have to be focused on the tech from the investing standpoint for the long-term fund? Or to your point, when this space matures, do you think we'll finally get to a point where we're just investing based on technical indicators, fundamental stuff like that?
No, I don't think it'll always be just based on technical indicators and stuff like that. I mean, the reality is this market right now is very dominated by quant funds and algo funds and those who are very good at exchange arbitrage and price arbitrage and different signals. That is the definition of an immature market, right? A lot of those inefficiencies that people are trading on will go away as the market becomes more efficient and as more money comes in and as there's more sticky kind of buy and hold investors. But with regard to the tech specifically, I think we're already seeing an evolution in this crypto ecosystem where it's not just protocols and platforms. You're starting to see real companies utilize the tokens. I know the STO market itself hasn't really taken off yet because there's not a lot of two-sided liquidity there yet. Mm-hmm. But things like you just mentioned, Binance Coin's adaptation and what Bitfinex did. There's new ones with FTX and RenRenBit that are out there. You're going to start seeing even what Algorand did recently with, attaching a put basically a year out from what they raised. I mean, a lot of these things are going to be much less necessarily about the tech and much more about the actual security itself and how it's structured. So it lends itself more to financial engineering than necessarily just technology investing.
So going on the financial engineering side of this, let's compare something like Algorand to a venture style fund versus what you guys do at Arca to frame this conversation a little bit. If I was a venture style fund, maybe I would invest in Algorand 2-3 years ago, something like that, get a bunch of tokens early. If I was you guys focused more on the finance side, the engineering kind of side of the finance world, how would you play Algorand, or have you?
Sure. Yeah, I mean, I think in general, again, for any investors who are doing this on their own, everybody needs to do their own research on anything that they own, because again, there are these nuances and there are these different structural events. But certainly the difference between a venture fund, they are probably looking at the team and the technology and the long-term viability of Algorand 5-7 years from now. Whereas a more liquid fund might be looking at something that's more like a day or a week or a month out. So without going into the specifics on what we did with Algorand, there were ways to come up with a trade and a structure using the combination of the actual token itself and the put that they were offering in their Dutch auction to come up with an investment thesis and a risk reward trade that was kind of independent of where Algorand is 3, 5, 7 years from now.
Makes sense. And Jeff, it's a new industry here. It happens on Twitter and Reddit and calls and everything from ETH magicians to meetups. How do you personally get out of the echo chamber of crypto Twitter? Because I feel like it's a black hole at sometimes.
Yeah, it's definitely hard. And all of us succumb to it at some point. It's just it's kudos to Twitter. It's addicting. The reality is sourcing is a big part of any investment fund, right? Whether you're a venture fund or private equity or, a mutual fund or a, ETF, whatever. I mean, sourcing ideas is very hard. And like anything, it's about filtering. right? So you have people on your team that are good at certain things. So I think one of the most underrated part of structuring an investment fund is the people, right? A lot of funds in the crypto space are one or two people who do everything. But the role of portfolio manager is very different than the role of analyst, which is very different than the role of trader, which is very different than the role of back office or compliance. And these are different skill sets that you learn over time from having done it in other places, as well as from being an understudy from senior people. So on my team specifically, like I'm the chief investment officer, and I'm really focused on higher level macro education of investors, things like that. Our portfolio manager is much more involved in the sourcing and finding who he trusts and who he doesn't, and making sure that he vets the different sources and tries to find good ideas from bad ideas. My trader is on the front lines. Like they're battling, they basically have a sword out there just fighting off things all day long from Twitter and, GitHub and Telegram and Reddit, and just trying to filter out 99% of what comes in and present to us one or two things that are actually investable. Then that goes over to the analyst. What's the analyst jobs? They're taking the one or two things that are really investable and trying to dig deeper and come up with the actual long-term thesis. So all these pieces work together. I'd certainly caution any of the younger people out there who are starting to try to build a fund themselves or trying to do this. They're not to sound like the old guy in the room, which I know I am, but there is real value in having learned under other people. I mean, I was a trader for 3.5 years between Lehman and Merril before anyone let me touch the money. I would watch what others did. I would help them out. I would help them with ideas, but I was not physically in charge of the money myself for many years. And that the lessons I learned underneath these guys and these girls and guys that I worked with for years, I still apply today. So understanding your different role, understanding what the structure is, having experience, both life experience as well as work experience, kind of helps you just get better at that filtering and that sourcing and avoiding the time sucks that don't create any actual value.
It's a breath of fresh air to hear all the pieces of the puzzle are working together. I'm used to talking to a lot of people in the space where one person's just making all the decisions.
Yeah, and it's very hard to do that, especially in an industry that is 24/7. While we all agree that this is becoming a machine world, not a person world. So as a result, there's no reason to have banking hours or things like that. At the same time, no matter how bad your week is, if it ends Friday at 4 p.m. and you get a weekend to reset and think, you might come back with a different vantage point Monday morning than you do if this never closes and you never have a chance to think. So on the Arca team, we basically strictly enforce that everybody on the team has to take one day off a week where they're not looking at the screens, they're not touching anything, because you really do need that mental refresh. It is more important to have a clear head and to think things through when you're making investments, especially as a fiduciary of capital for other people. It's much more important to have a clear head and think objectively than it is to see every price move or every piece of news or every single, tick that'll keep you up at night and drive you crazy.
Yeah, that's awesome. The one day off of school, I feel like we're never off with Telegram and Twitter and 24/7 markets here. Yeah, that's great.
It's very hard. It is a discipline much more than it is a investment thesis.
And Jeff, you have a huge focus on risk and sizing and weighting, and I feel like that's somewhat new to the space. It's obviously not new to finance. Do you feel that you're one of the few funds that are taking a real strict focus on portfolio sizing and weighting and allocations and all that stuff?
I think we're very good at it. I certainly can't comment on all the different funds that are out there. I will say that, think of the genesis of how crypto started, right? It was developers, it was technologists, it was people who, God bless them, we wouldn't be here without them. And they created all this great technology that we're now investing in and utilizing. But that's obviously a very different skill set than somebody who has spent 20 years in and around finance and asset management. And you wouldn't expect me to be able to go write code any better than you'd expect them to go out there and run risk models right away. It takes time. The evolution beyond the early technologists was then the venture firms, right? Who's the best at thinking 20 years out? Venture capitalists, right? That's what they do. So they saw the benefits of crypto and digital assets and blockchain much faster than other people. Well, again, not a knock on venture capital people, but what are they good at? Very good at buying. They're not that great at selling. They don't have to. That's not part of their job. They don't have to reweight their portfolio. They don't have to manage the risk on a day-to-day basis. So it's just a very different skill set. So as the market goes from, very, 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 very early stage speculative to, much more the larger venture, funded ecosystem to day in and day out trading and risk management, it just requires different skill sets. And we have put a team together at Arca that has all these different skill sets, from my banking and trading and asset management background to one of our portfolio managers who was 10 years international M&A banking at KPMG, to our analyst who is 5 years venture capital experience, to our trader who lives and breathes crypto. Right down the line, we have one of our partners was 20 years as a securities lawyer and has structured every kind of fund product you can imagine under the sun. Our CEO was the co-founder of Wisdom Tree, which is a $60 billion ETF company, right? So right down the list, we all have very different, unique skill sets that all ultimately come together in the right form to execute the strategy that we are trying to do on behalf of our investors.
Yeah, your whole execution style with all the pieces makes so much sense from a traditional finance aspect. I just feel like it catches a lot of people by surprise at how good it's set up compared to some other funds where it's, maybe $50 million with one person or $150 million with one person or a small team making all the decisions. It's definitely harder.
Well, I'd encourage any of them who want to learn what we do to talk to us, and vice versa. We could learn from them, right? There's no one way to do this.
That's a good point.
We have a way of doing it that we have done for decades, and we're doing it and applying it to crypto. But, we certainly don't think we're the only ones doing it right. We just think we're doing it, well.
Good point. And Jeff, to close out, 2 questions on kind of the history of Arca versus today. How do your old colleagues at Lehman, Citadel, how did they feel when you first got into crypto versus how do you think they're thinking about things today?
It's funny. The every single person that I've ever come across starts the same place, which is pure skepticism. I'm sure there's a few people here and there who bought into this right away, but most of the people, especially in the traditional finance space, start with complete skepticism. And eventually, over the course of talking to people and writing and learning and reading, or eventually you hit that tipping point where the light bulb goes off and you start to get it. But I think, a lot of people in crypto, and just like in any other industry, you become very myopic, right? You're so focused on what you do, you don't realize that there's other people out there who don't care as much as you do. And, I had this same thing when I was, in the high yield and distress market. I thought I was in New York. I was going to bars 4 nights a week, talking to all the other high yield distress guys. I thought I knew everybody. I thought I knew everything about finance. Then I left the industry, went to Harvest Exchange, and realized, I don't know any of the venture capital people. I don't know any of the private equity people, any of the financial advisors, right? There's a whole other world out there. And crypto's no different, right? We follow every tick of Bitcoin, every tick of Ethereum, and we think everybody's watching, everybody cares. And the reality is, like, even, when the market goes from 10.5 to 14 to 8, back to 10.5, we're living and breathing this, and everyone else is just saying, oh, Bitcoin's unchanged. Look at that. Because they look at it once a month or once every 2 months, and it's just not part of their everyday. So I think there's certainly a growing number of people on these big banks and these big hedge funds and these other big desks who are starting to be aware of it. Certainly the macro funds are starting to realize that Bitcoin is, important from no different than gold in terms of a macro hedge or a store of value. I think some of the big banks are aware of obviously what Facebook is doing or other stable tokens or other things that impinge on the banking system. But the day-to-day employee who is so wrapped up in what they're doing probably isn't thinking about it that much and kind of still thinks of it as a hobby more than a career.
Great points. And Jeff, going back to your earlier point on the market being too small to allocate a ton of money to it, say, billions or tens of billions of Bitcoin, as the macro argument takes off and countries allocate and pension funds allocate, let's stick to Bitcoin for this question. Do you think that that's like an exponential growth curve that could drive some insane returns? Or do you think that that's just too naive and people will position size the right way if you're a professional manager?
No, I think it depends. It's a good question. I think the exponential growth is certainly in play. The amount of money that's out there that is not in crypto obviously dwarfs the amount that is in crypto. Independent of all the leverage games and things that are going on today that drive a lot of pricing, just a straight, 1-to-1 allocation from some of these enormous sovereign wealth funds or banks or institutional funds. I mean, you can do the math on how high this could go as a result of that. Ultimately, it doesn't come down to price, right? Price isn't going to be the deterring factor. It's going to be whether or not they can model this in some way or because it serves a purpose, right? So if you are a very, dollar denominated fund and you are just incredibly terrified of all of the shenanigans that are going on in the government right now with monetary policy and inflation, you don't care where it trades. If you believe it's a macro hedge to what you're doing, you're going to invest some percentage of your assets to protect against that, right? If you are a macro fund that is making outright bets on this, you're going to allocate a certain percentage of your fund to wherever that risk bucket is that, makes bets in that regard. So I don't think the price ultimately becomes a deterrent. I think it's really more people understanding where this fits in their portfolio and how to make it work.
And last history question for you, Jeff.
Edit that out. Don't worry.
Whoops. Good thing we're not doing this live, guys. Jeff, last history question for you. A lot of people look back to 2008 and 2009 and they say, oh, crypto could be a bubble, or I think people start looking at DeFi as, a potential risk factor or black swan event. It feels like so long ago it really isn't, but it's after most people got involved in crypto. Do you think that we'll ever have that type of cataclysmic type event in this market, or do you think that is a new world?
Well, I mean, the whole reason the term black swan came about is because it's something that is rare. Rare doesn't mean it doesn't exist. Rare just means it doesn't happen often. There are always going to be black swan events, and it's very difficult to prepare for them. I mean, some people and some firms obviously did better than others in 2008 to foresee it and prepare for it. But 2008 is not the only one, right? You had 2001 with the equity bubble, right? You had 1998 long-term capital management in Asia. You had obviously the savings and loan crisis. I believe that was in the 80s. So these things happen all the time. I don't know what the next one will be. What I can say is 2008 was a really hard time for me. I was managing risk. I had risk officers all over the Merril Lynch floor, people I'd never seen in 4 years working there. All of a sudden we're walking around the floor with, effectively guns in the back of your head telling you to reduce risk. And we're sitting here thinking, like, what is going on? How bad could it really be out there? We didn't know. And it was a hard time, and I learned a ton in that environment. Also learned a ton from other people who were 10, 20, 30 years my senior. So again, going back to that apprenticeship idea. But all you can do is prepare for this stuff, right? So yes, there will be a black swan event. I know a lot of people in crypto think that government and banking is bad and it's going to go away. The reality is, if it goes really haywire, that's terrible for all of us. Even if long term it's good for the crypto for the crypto space, it's not good short term. And I certainly don't wish the events of 2008 on anyone, because that wiped a lot of people out.
Yeah,
but
God,
it's
no.
It will happen. It always happens. We don't know where it's coming from or when. But these are the risks that you have to think about. These are the risks you have to prepare for. It's always easy to react to something if you had thought through what you might do in a scenario, even if that scenario is very unlikely. I have 2 young kids now. We practice fire drills, every 3 months, and the kids run frantically out of the house and don't really know what's going on. But, I have never had a fire in 40 years of life, but that could happen, and you have to prepare for that. And it's very similar in, when you're talking about macroeconomics and investing.
And Jeff, building on that point, let's say we do go into a recession, God forbid a depression. What do you think happens to crypto? Do you think people sell their magical internet money for food, or do you think it's a flight to a safe haven?
So right now, I think Bitcoin is in the perfect Goldilocks scenario, right? Not too hot, not too cold, because it really is both a risk asset and a safe haven at the same time, which is why Bitcoin has gone so much higher in the last 6 months and probably will continue to do so over the course of the next few years. But everything changes when you get into a full-fledged calamity. Correlation generally goes to 1 across all asset classes when things are really bad, because everything has a spillover effect, right? If you are, levered long in one place and you're getting crushed, you sell anything you can to cover that capital call, or that collateral call to save it, right? That's why in 2008, money markets actually traded below $1, called breaking the buck. They broke the buck because people had to sell it just to, offset problems they were having elsewhere. So I think near term in a calamity, Bitcoin probably goes down like everything else, but I don't think it would be very long-lived. I think ultimately people will recognize the safety in something like Bitcoin relative to other assets. Again, depending on what that event is, right? If it really is caused by government or banking or the things that are getting us into this speculative bubble with asset prices across the world, I think Bitcoin will come out of that in a very good way, but it might not be right away. You might see the same, short-term downward effects on every asset class, regardless of what it is.
So kind of like a short-term hit, but long-term, people will then understand the need for something that's uncorrelated and not controlled by their government, et cetera.
Exactly. And hopefully that education process happens before that happens. Hopefully that isn't the reason or the wake-up call that the world needs. But certainly, yes, I think that would strengthen the narrative.
Makes sense. And Jeff, thanks for coming on. Where can people follow you and learn more about Arca?
Sure. It's been a lot of fun doing this. Thanks for having me. On Twitter, you can find me at jdorman81. On our website, Arca, which is ar.ca, we have a lot of videos and blogs and other educational tools for both individual investors as well as institutional investors. And feel free to, people can shoot me an email or talk to me on LinkedIn or Twitter. I like to really engage with the community. And like I said, both give people what I know about this market as well as learn from others.
Jeff, I definitely point people to follow you because you're like the ice cold splash that people need most of the time on Twitter. And Ryan Gorman, thank you so much for setting this up. I'm going to tag Jeff, Ryan, and the site in the show notes below. Thanks so much, Jeff.
Thank you. And to you and your team at Delphi Digital, congrats on everything you guys have accomplished. You guys are really doing great things for this industry.
Thanks so much, Jeff. Hey everyone, if you enjoyed listening to the episode, please share it on Twitter and LinkedIn and give us a 5-star rating in the iTunes store.